much more information at fingertips, and it's not necessarily good information. I mean, you see the pumping on Twitter, you see the pumping on social media as a whole. Then you get into, you know, different TV shows and different things like that, where they and I always remind people of this is, you know, we look at CNBC or we look at Fox Business and we say, oh, these guys, you know, they're kind of unbiased. But the bottom line is we have to remember that TV, the way they stay in business is by selling, you know, commercials, right? And so if you're very, you know, matter of fact, and you don't bring emotion, you don't get people to watch through kind of triggering these emotional responses, then they don't make any money, and then they'll be off the air. So they're going to harp on things like big moves in this stock up or down and kind of the crazier stuff in the market because they want people to be watching, and then they can charge more for those interviews. So yeah, I mean, in this day and age, it is nuts out there. I do feel bad for new investors starting because of all the kind of things that they have to navigate. It reminds me of, I mean, if you go back to the 60s and 70s, now I wasn't trading, but if you were going to invest in stocks, there wasn't a whole lot. You got the Wall Street Journal probably, and that was about it. And then you had a broker that you had to call on the phone. You know, when I came up, then E-Trade was just starting, you know, and it was like, I don't know, it was like $15, $20 to buy a stock, $15, $20 to sell. And now you're at a point where it's free, and you can do it on your phone, and you can go on Twitter and find out who's pumping the stock with the best narrative and get all excited about it. And it just kind of sweeps more and more people into this. Now, whether or not they have the fiduciary responsibility, I think what they need to do, and I don't know if, you know, Robinhood does this. I'm not a member of Robinhood, but I do think there has to be, you know, the information made available. But at the same time, I'm kind of in that, maybe it's a little old school feeling of like, I went through the tough time of learning, and the way I learned was by losing money. Now it sucked. You know, no one wants to lose money. Luckily, when I first started, I didn't have a lot of money to lose, but there was kind of a progression of my learning curve by making mistakes. And I think that, you know, these platforms need to make the proper education available, you know, partner with the right people to at least offer it. But you can't really, you know, I hate it when someone's like, oh, you know, I bought Bitcoin at 68,000 and, you know, that person told me to, and I'm going to blame them. I don't think that's fair either, because then again, you know, everyone has to make their own decisions, and we have to learn our lessons. You know, you are watching, when you see that emotional reaction, what it's telling you is those people have committed far too much capital to one side of the market. And when that happens, it inevitably is going to come down the opposite direction. And so again, using that, you know, remember, markets are a representation of human emotion. They're made up of millions of people that are buying because they're greedy, or they're selling because they're fearful. And a chart represents that emotion. So you're reading human emotion. And that's why at extremes, you see these kind of max greed and max fear points, you know, AKA back in October, November with Bitcoin. I mean, literally, if I said anything negative about Bitcoin, I would get ridiculously attacked on Twitter. But again, that was showing that max emotional kind of bias, which was a dead marking of the top. There's still a lot of speculative money in the market, and you probably won't flush that out all the way until, I mean, when you see the S&P down 30%, 40%, you'll start to get to that point. But there's going to be, I mean, there are people that made a lot of money in the market between GameStop and AMC and Bitcoin and some of these altcoins, and they continue to, you know, find some of these altcoins that are like, you know, nothings and play them and make large amounts of money. So there's still a lot of spec money out there. Tesla, you're right. It is, to me, you know, in fact, I watched Tesla to kind of determine what the next move on Bitcoin is going to be, literally, because it does really track. And it's the same thing. It's the name, it's the love for it. People have this like affinity for Elon Musk. And I mean, he's a genius. There's no doubt about it. But I've always been a proponent of, listen, stocks are here for us to trade, right? We're here to make money, whether it's long or short. You know, just play the right move, and that's fine. You never want to fall in love with anything, because that's how we all get burned, right? But yeah, I do think there's a ton of spec money still in the market. I think you still see it. And I think when you get these buy the dips, they get accelerated, you know, to the upside by that spec money coming back in and chasing, and that kind of buy the dip mentality that is still there. I mean, even when you look at the markets, as much as they're down now, there's still that buy the dip. I mean, you still talk to people and they're still saying we're going to go back to all-time highs soon. In fact, some analysts are even still saying that. I heard it, you know, from like a JP Morgan or someone else, you know, recently, like, oh, we're going to have a big move. I don't believe it. I think, again, you have to look at what the Fed is doing. The bubble is beginning to deflate. And the only way for them to reverse that is if they somehow started to print money again. And again, at this stage with 8-10% inflation, I don't think that's possible. You know, if most people hear me talk and they're like, oh, that's Gareth, he's like hugely bearish on Bitcoin, but you can trade the levels. And again, when it hits support, you buy. When it hits resistance, you sell in the near term. And then the long term, and this is where, the time frames do matter, like you're saying. My long term, I think Bitcoin is a game changer. I really personally believe that there's a need to get away from fiat currency. There's a need to get away from the ability for the Fed to just print, and how to protect ourselves from that depreciation of the dollar and losing value over time by them just printing us out of every issue. And I strongly believe that as soon as inflation comes down to 5%, but unemployment rises to 10%, they're going to go right back to their playbook and start printing money again. And so you need that. So time frame, unbelievably important, and a smart investor understands that time frame. You can be very short term looking for a bounce, midterm can be down more, and then maybe long term is very, very bullish as well. And you have to be able to kind of trade it accordingly. You have to pick the time frame that you want to be involved in, or not at all, right? Because you can just be in cash and just wait patiently. That's fine too. But again, you have to look at the time frame you're trading and where the move should be, and position yourself for that move specifically. You can't, that's not for everyone. It is a very dangerous thing to do. I have 20 years of trading experience in terms of reading charts, reading support resistance. I understand cycle analysis. I mean, there's a lot of things that I've done in my career that has been working on this to get to a point where I feel comfortable and have proven that track record over and over again. For someone to just go out and say, oh, I think I should buy, Facebook here or Apple here. I mean, there has to be major reasons behind it that you can go and say, okay, I can look myself in the mirror and I can say, okay, A, B, and C, and they can't be emotional, right? They have to be, and honestly, they shouldn't even be fundamental. Fundamentals to me, and everyone asks me this about on-chain analysis with crypto too. And on-chain analysis is like the fundamental analysis for crypto, but same thing for stocks. Yes, it means something in the long term, but in the short term, the only thing that matters is fear and greed, right? Fear and greed rule the market. That's why things are dumping, or that's why things are ripping, because you have buyers or you have sellers, greed and fear. And so you have to really have some foundational basis for making plays if you're going to be in the stock pickers world. Otherwise, you basically have two opportunities. One is to sit in cash and then wait for things to get to levels that you feel comfortable with and understand that you may be wrong and just sit with it. Or you just stay in cash. But certainly it is, at this point, for me, when I go long stocks, I am not buying for years. I'm buying for weeks, maybe a month for a bounce here and there. And then I'm out, and maybe I'm even looking to short. So I do day trading, and my day trading accuracy is higher than my swing trade and even really longer term investing in terms of, again, my longer term is like a few months. But the reason why day trading is, to me, and listen, day trading, again, is very tricky, a lot of risks involved. But the reason why day trading for me, I have a higher percentage win rate is because you're exposing your money for less time. The less time you have it in the market, the less time there is for something to go wrong. If you're in it for literally minutes or seconds or an hour, then you're out of it. You go to bed in cash. You don't have to worry about China doing something or Russia invading Ukraine. You come back the next morning, you get in at a specific level, you get out.